From New York, though, we head out to where all the central bankers are, Jackson Hole, Wyoming. That's where we find our next guest, who shot to fame after forecasting the financial sector's carnage in recent years. She made a correct call there, and we're asking what she sees next on the horizon. Meredith Whitney, the CEO of Meredith Whitney Advisory Group, is with us live from Jackson Hole this morning. Meredith, you heard the Fed chairman say, yes, we're moving out of recession, but he said there are still strains to come on the financial system. Where do you think we stand?
I think it's a slow way, a slow move out. It seems as if the panic and crisis is behind us. The floor has been set for the financials. But in terms of liquidity for the consumer, assets, troubled assets still at the banks, we still have a ways to go in terms of working through those things. Unemployment also is a big question mark, a big what if. And I think that what the chairman said this morning really there wasn't anything new in it as far as I was concerned. And the consensus here is, we're through a very tough patch, but there's still a lot of work that needs to be done.
77.
I think what you've seen, and I think.
Oh, sorry. Go ahead.
I think what you've seen in the financials is the financials rally strongly off of an oversold market, panic that probably was undue panic in terms of solvency risk, and now you're getting probably an overly zealous reaction about what the banks can earn on a core basis over the next couple of years. It may be pushed out for the next 3-4 years, but certainly there's the fears of solvency are well behind us.
You've raised concerns about the level of credit that needs to come out of the system there. When you're talking about the banks, you're talking about the financial sector. Where are we in the cleansing process? Where are we in bank closures?
I think that actually we're early on in terms of bank closures. We write a lot about this in terms of there's 77, now 78 bank closures, counting Guarantee Financial. We estimate there are going to be over 300 bank closures, and probably about 5 to 8% of bank liquidity taken out of the system. So there are fewer banks this time than there were in the last cycle, so there'll be fewer closures. Remember, there were thousands of closures in the last cycle. There'll be hundreds of closures in this cycle, and I think as I said, we're up to 3x more bank failures, and you're starting to see that. Today's the magic day. Most bank failures happen on Friday. You're starting to see, I think, an increasing volume of that. What we think that means is that it strains liquidity from various communities. When banks have failed, there isn't the big risk associated in panic in the markets, but certainly liquidity comes out of those communities, and some banks have been slow to take up the slack.
And what is that impact then? What's the extension of that to credit, to liquidity, and then the trickle down from the banks to the consumers themselves?
Well, one thing I care very much about is how does all this policy, how do all these changes impact the guy on Main Street, the small business owner on Main Street? And in fact, the guy on Main Street and the small business owner on Main Street continues to see liquidity come away from him and her. And what you see, actually, if you look at credit cards, and 90% of Americans revolve at least one time a year with their credit cards. Small businesses predominantly fund themselves with personal credit cards. You've seen over $1 trillion of liquidity taken out of that market, and I think you're going to see over $2.5 trillion taken out of the market at the end of the day. Nothing's improved there, and so spending is going to take a long time to come back. I mean, these are the other issues. So banks may be, many banks may be okay for a while, but the real driver of the economy, which is consumer spending, I don't expect to come back anytime soon.
Yesterday, we saw a strong move in the financial sector. AIG rallied on headlines from Bloomberg that AIG is looking to repay TARP money, but no deadline given there. When you look at some of the other banks out there, Bank of America, Citigroup, some of the other TARP recipients, what's your calendar there for what's your forecast on when repayment of TARP money will be happening?
Well, there are a couple examples. Don't forget that UBS was up very strongly on its anticipation of getting out of, or the Swiss government selling its stake in UBS. So there are many banks that are moving forward in terms of having government assistance and having that government assistance wear off or being paid back. I think you're going to have to see, in the case of Citi start to sell assets, raise capital through asset dispositions to be able to buy the government stake back. With respect to Bank of America has monetized a lot of assets, and I think on a go-forward basis, if you see the yield curve still so steep, and if you see the government and central banks across the globe buying and effectively propping up security, asset values, you'll see greater capital relief for a lot of these banks and enable them to have more financial flexibility. That's, you can argue what the long-term benefits of that are, but I think you're going to see capital relief for these banks. They just have to make sure, I would just say with the European banks, take the capital relief and raise real capital.
Okay.
In terms of public capital. It's a lot of moving parts.
All right. Thank you so much, Meredith Whitney. Always great insight from you. Thank you for joining us today, Meredith Whitney of the Meredith Whitney Group.